Thank you for visiting with us to learn more about individual retirement accounts. Today's presenters are Frank and Brian Harlander, who work with families who want to increase their retirement savings and reduce the taxes they pay. The objectives of this presentation are to provide you with some more pertinent aspects of traditional and Roth IRAs. Some of the key issues that we will be discussing are outlined above. Understanding the tax laws allows individuals to better avoid tax landmines and to increase their capacity to build wealth for their retirement years. The annual contribution for the 2013 calendar year is $5,500 for persons under 50 and $6,500 for persons age 50 or older. The limitations are the same for traditional and Roth IRAs. The annual contribution limit can be split between a traditional and Roth IRA. It is important to note that new IRA accounts must be created by the due date of the filing of Form 1040, and the IRA must be funded by the same date. The normal filing date is usually April 15th. Thus, for 2013 IRAs, the account and contributions must be completed by April 15, 2014. The fact that you file an extension of time to file Form 1040 does not change this IRS due date. In order to make a contribution to a traditional IRA, you must be an employee or be self-employed and have earned income. Thus, a self-employed person whose business is operating at a loss would not meet the earned income test and could not make an IRA contribution. Since required minimum distributions must be made when a taxpayer reaches age 70 and a half, the taxpayer can no longer make annual contributions to his traditional IRA. There are special spousal rules that allow one spouse who has earned income to make contributions to the spouse's IRA account. The appeal of a traditional IRA is that it can be tax deductible in Form 1040. If the employee is not an active participant in the employer's retirement plan, then the IRA contribution is tax deductible. For those individuals who are not active participants in their employer's retirement plan, the tax deduction is phased out based on the taxpayer's modified adjusted gross income. The phase out for married persons filing jointly begins at $95,000 and is fully phased out when their modified AGI is $115,000 or greater. There are different phase-outs for each filing status, whether it be married filing jointly, separately, head of household, or single. The W-2 that the employee receives each year from their employer will have a box marked if the employee is an active participant in the employer's retirement plan. For families who change jobs during the year, they may not be covered by the new employer's plan because of waiting period rules. Thus, a tax planning opportunity may be available. Whereas traditional IRAs may be tax deductible, a Roth IRA contribution is never tax deductible. This slide shows the modified AGI phase-out to contribute to a Roth IRA for married filing jointly taxpayers. Similar to the traditional IRA, there are modified AGI phase-outs for each filing status. There is a tax planning strategy that may allow some taxpayers who exceed the modified AGI limitations to make a Roth IRA contribution. If this is something that would be of interest to you, we have a blog posting dated March 7, 2012 that explains how this can be done. If you are not a current subscriber to our blog, we recommend that you consider subscribing. You do not have to be a tax client of our firm, and there are several blog postings that have financially benefited our subscribers. If you make non-deductible IRA contributions, be sure to notify your tax professional as Form 8606 is required to be filed. The failure to file this form can be quite costly when distributions are eventually made from your IRA account. The IRS has provisions that allow taxpayers to convert a traditional IRA to a Roth IRA. These conversions are allowed by the IRS because they are taxable events. If you are under 59.5, the 10% early distribution penalty will not apply. These conversions will have a look-back period. If you made a conversion and the account that was converted had a dismal financial result after the conversion, there are rules that may allow you to undo the conversion. When considering if converting a traditional IRA to a Roth IRA makes financial sense, you must work very closely with your tax advisor. If you have to use funds within the IRA to pay the income taxes due on the conversion, it is safe to say that the conversion will not make economic sense. Other factors that need to be considered are the age of the taxpayer when the conversion is made and what the taxpayer believes his or her future income tax rate will be compared to the rate paid on the conversion. For individuals who are charitable-minded, it may be possible to use the tax deduction related to the charitable contribution to offset the tax due on the conversion. Traditional IRAs require that the account holder begin to withdraw the required minimum distributions, or RMD, beginning at age 70.5. Some brokerage firms will compute the RMD for taxpayers as a courtesy to their client, but will not assume any responsibility for the accuracy of the RMD computation. Since the penalties for failure to take the required RMD are onerous, taxpayers should consider having the RMD computed by their tax professional. The RMD need not be withdrawn from each traditional IRA account. The only requirement is that the required RMD for all account balances be withdrawn from at least one IRA account. Thus, a financial strategy could possibly make the RMD from the account or accounts with the lowest rate of return. The account holder, while alive, should establish primary and contingent beneficiaries to provide for maximum income and estate tax planning. When an account holder dies, the beneficiaries of the IRA account will be sent paperwork regarding how the distributions should be made. Before signing and returning any documents, it is best to discuss your options with your tax advisor. For non-spousal inheritances, see if the IRA account has already been split into separate accounts for each beneficiary. If not, inquire if the IRA account can be split into separate accounts to provide the beneficiaries with the greatest flexibility to meet their needs. As this slide illustrates, there are many rules regarding how non-spousal inherited IRA distributions are made. Some tax advisors suggest to their elderly clients that they take their RMDs in January of each year. This lessens the chance that the beneficiaries will be required to take RMDs in the year of death. Non-spousal IRA inheritances must be taken over a 5-year period or over the IRS life of the beneficiary. We had mentioned in an earlier slide about creating separate IRAs for the beneficiaries. The reason for this is that if there is a vast age difference between the beneficiaries, the IRS distribution life for all beneficiaries will be over the life expectancy of the oldest beneficiary. Since traditional IRAs can consist of tax-deductible and non-tax-deductible contributions, there exist special rules that determine how much of each distribution is taxable and how much each distribution is non-taxable. The greater the portion of account that consists of previously tax-deductible contributions, the greater the portion that will be taxed when the distribution is made. What the government gives, the government takes away. If you receive a tax savings when the contribution was made, you will pay income taxes when the funds are distributed to you. Since Roth contributions never result in a tax deduction, the withdrawals of the contributions are not taxed. As this slide illustrates, there are ordering rules with how distributions from Roth IRAs are made. Many persons know that there exists a 5-year waiting rule for Roth IRAs. Few people understand that there are actually 2 5-year waiting rules and how they work. This slide hopefully provides some guidance on those rules. The tax rules are complex, and ignorance of the rules cannot be relied upon a taxpayer as an excuse for noncompliance or for incurring more taxes than necessary. This slide illustrates that there are different rules for qualified and non-qualified Roth distributions. While qualified distributions may be income tax-free, the same does not hold for non-qualified distributions. We will discuss qualified distributions on the next slide. There are 2 tests that must be satisfied to have a qualified IRA distribution. The slide summarizes those 2 tests. In an earlier slide, we had mentioned that we recommend that RMDs must be verified by the taxpayer's tax professional. The IRS imposes a 50% penalty on amounts that should have been distributed for an RMD, but were not. That is a very substantial penalty. Surprisingly, each year we hear of taxpayers who have filed their own returns and never made an RMD after reaching age 70 and a half. The IRS also imposes a 6% annual penalty on excess IRA contributions. Rather than working with a tax advisor, some taxpayers make contributions to their IRAs and later learn that they were not eligible to make an IRA contribution. The 10% penalty referred to in this slide relates to traditional IRA withdrawals made before the taxpayer attained age 59 and a half. In these slides, the advantages shown do not mean that they are not available to Roth IRAs. There is just a listing of some of the traditional IRA benefits. We have discussed each of these items in earlier slides. The true advantages of a Roth IRA are that distributions are normally not taxable and RMDs are not required. This allows taxpayers to accumulate much wealth in his or her IRA without having to distribute those funds if not needed by the taxpayer. When speaking with taxpayers about whether it is best to invest in a traditional IRA and receive a current tax deduction or a Roth IRA and receive no tax benefit, we simply ask them the following question. Assume that you have $5,000 to invest in an IRA. If you are in a 20% tax bracket, you will receive $1,000 tax savings with the traditional IRA. Now assume that the IRA grows to $1 million. What is the value of that $1,000 tax savings? Would you rather pay no income taxes on the Roth IRA when the $1 million is distributed to you? Or assuming that you are in the 15% tax bracket when the RMD from the traditional IRA are made and pay $150,000 in income taxes? That is a scenario that every taxpayer should be asking themselves when contemplating making a contribution to a traditional IRA if they are eligible to make a contribution to a Roth IRA. In earlier slides, we discussed non-spousal IRA beneficiary inheritance rules. Starting with this slide, we are focusing on the spousal inheritance rules. These bullets illustrate the need to consult with a tax advisor before deciding how IRA inheritances should be handled by a spouse. The first tip, while having already been addressed in prior slides, is worth repeating here because of its importance. Tax planning is all about knowing the tax rules and structuring your transactions in the most tax-efficient manner. The purpose of this slide was to once again illustrate the need to understand the various tax rules. As the slide states, stretch IRAs have received much publicity. Certain financial advisors have run illustrations showing how millions of dollars can be deferred to future generations if the client would work with them. Stretch IRAs are not magically generated by an advisor making a special election or doing something special.